This is the European edition of Breaking Banks, the world's #1 fintech podcast and radio show. We bring you the European unicorns, startups, founders, regulators, and leaders innovating the rapidly evolving fintech scene today. A truly localized podcast with both English and local language content, with some of the world's most well-known hosts and influencers in the fintech sector globally. Join us every week as we explore what makes the European Union a phenomenal proving ground for many of the fastest growing fintech players in the world today. Okay, let's roll.
Hey guys, welcome back to Breaking Banks Europe, hosted by the CXO conversation at the Singapore Fintech Festival. I'm here with my friend Parul Khanna, director of Pinbox Solution, co-founder as well. Parul, welcome to Breaking Banks Europe.
Thank you so much for having me, Matteo. Always a pleasure.
You are a master in a topic that I cherish a lot for two reasons. One, because we work a lot in Africa, even if you're based here, but your remit is absolutely global. And we work together in emerging markets in a topic that is very unpopular, which is the whole pension. I would like you to start by the traditional 2 minutes of introduction. I know it's going to be complicated. And then let's dive into it because, as I said, I don't think we talk enough about this topic.
The problem is a very here and now problem, right? I think old age poverty among the future elderly is a much larger problem than the poverty or the elderly facing any challenges today. And I've said this several times, and at the cost of repeating myself, honestly, Matteo, if I just give you some perspective, and probably the listeners as well, there are 1.8, 1.6 billion people above the age of 65 currently. By 2050, 55, there will be over 2.2 million people above the age of 65. 8 out of 10 of those are going to live in Asia, Africa, and Latin America, right? Because all the young countries will now start aging. Africa probably a little later, but Asia and Latin America certainly have started aging. Now, each of these countries, if you just slice and dice them out, have less than 10% taxpayers. 80% of the population in any of these continents in the developing emerging markets are in informal sector. That means they're self-employed. Again, out of these 80%, 20 to 25% of those are going to be dissavers. That means they will never be able to accumulate enough money because their income cycle right now doesn't permit them to save enough. So the reason I make this bifurcation is because when we think of low-income individuals, self-employed, we're thinking ultra poor. Oh, how is he going to save? He's thinking only about today, right? But we keep forgetting that there is this middle emerging market which is growing very fast. There are gig workers, there are farmers, there are seamstresses, there are self-help groups, So there's so many of these who earn anywhere between $400 to $500 minimum a month. And they're the ones who are self-employed and don't see the horizon of what they're going to look like in 20 to 30 to 40 years' time. Now, if I change my occupation to a domestic helper and I change your occupation to a taxi driver, then you and I will keep working till the time that we can. We don't have a retirement age in mind.
Absolutely.
And the reason is because the ecosystem doesn't exist. The perspective doesn't exist. Financial literacy doesn't exist. Concepts of compounding and inflation don't exist. And we have interim needs that we want to take care of, which is child's marriage, housing, so on and so forth. And if there's anything left, we'll save for old age. But the intention is there. They understand that they will have this problem because God, fate, and children are not exactly very strong retirement portfolios,
Absolutely.
And with increasing dependency on saying that our children are going to take care of each other and they're going to take care of us is sort of becoming a little lackluster. It's going to be difficult. Everybody in Asia, Africa, Latin America, they all take care of our elderly. We don't send traditionally, culturally, our parents away. We keep them at home. We want to take care of them. But that is at the cost of something else. So it is very important that the youth and the women start saving today because by 2055 it is too late. You've already aged. And there will be people who will be old and destitute. The World Bank report says that by 2050, the biggest reason contributing to poverty will be old age poverty.
Interesting.
So it's a silver tsunami.
Absolutely.
Wake up.
Absolutely. While you were talking, I said, okay, I'll take a bet right now. And I think I'm going to ask a question that no one have asked before to you. And this is not your first interviews, right? But, be honest, maybe I'm not that original, right? So if you take the perspective of the institutions or of the government, is it easier to fix something broken at the pension level or to build something from scratch?
I'll break your question down even further. I'll first answer the first part. Is it okay to build something broken, right? They will never get to starting from scratch because you're already building something that is broken. Right? Something that doesn't exist, it's already broken. You will already have, say in India, there are...
Sorry. No. And it's okay because that's a podcast, is a conversation, it's not a panel. So I was trying to compare Western economies with emerging markets. So most of the Western economies' pension schemes are broken. Italy is a very good example, so every couple of years they increase the pensionable age for 2 years, is now 67. Of course, we are, living longer, but people is still as dumb, talking about my fellow Italian colleagues, in planning their pensions. So we are trying to fix it. So we fix something that is at the moment inherently broken. In Africa, for example, to take a completely opposite approach, there is barely any pension scheme. I mean, unless a pinbox has worked on that country, right? Because I don't know many players that took this challenge. So I was trying to compare the two.
For this, I'll have to explain pensions a little deeper to make people understand and give perspective on how it works.
And that's the objective. So
right?
It's this again.
So pension works in two ways. There is either a defined contribution pension, or it's a defined benefit pension, right? Most of the developed world have taken a defined pension, defined benefit pension, which means that it will be decided today that at age 60, what pension I will get, which is the case in Italy, right? And this is the case in Chile. And this is the case in a lot of the markets. So what happens in that is that when it's a government-sponsored scheme, the government is giving a commitment today that I will give you $5,000, just a certain number out of my head, at age 60. Now that $5,000, two things happen. If there are, say, 100,000 people in Italy who are going to get $5,000 at age 60, the government has to ensure, or the sponsor of the scheme has to ensure, whoever it is, that 100,000 people get that $5,000 pension, right?
Clear.
The other way the pension works is that there is a defined contribution, right? Which countries like India adopt, countries like Bangladesh have, countries like Rwanda have, which is when you say that your pension will be defined on how much contribution you make towards your pension account. Right? In that case, it is up to the individual how much money they put into the pension. Now, this can be in an employer-employee relationship, who's somebody who's formally employed, or it could be a farmer who earns twice a year because of his crop cycle, and he has the ability to put it twice. In this case, the markets and the return decides how much pension you get. Now, in both cases, they become very different, and the countries start pushing the age back in defined benefit is because they want people to work longer, and they may not have the funds due to other factors that they have used up the money over a period of time that they want to keep, like France, you keep pushing the age back. And hence you don't have a pool of money. But when it is already people how much money they've put in, then it is how much money you get back, and it is decided on the amount that you take. So this is one big difference in pensions. The second part, so to answer your question on broken or not, this also decides whether it is broken or not, right? In the nature of it. Secondly, a lot of countries like India, like Rwanda, like Kenya, want to include as many people to join pension schemes. And the reason is the opportunity is much bigger than the cost of not doing it at all, or losing out the cost of not doing it.
Yeah.
And the opportunity, again, if I tell you, even if 25% of each country of the informal sector workers start saving $1 a day, you will accumulate over 10 to 15 trillion of new assets that the governments can then consume for infrastructure, for whatever else that they want. So the opportunity is much bigger. So just to complete what I'm saying, in countries, that is why countries are now saying, especially the emerging markets, that why don't I incentivize that individual for a limited period of time, say 1 to 3 to 5 years, so that they get into a savings habit and are able to put away, and I become their employer substitute. The way I give the affluent tax benefits to put money into pensions, all countries give tax benefits when you voluntarily contribute. So they're saying, because there is no employer in this case and they're not taxpayers either, so why don't I give the informal sector, self-employed people, some incentive for 3 to 5 years in the hope that they start getting onto pensions?
Parul, you mentioned something, quote unquote, we give them incentives to, right? Which implies to educate, population that have indeed as a first, let's say, worry, to put food on the table. Because even if for the $300 to $500 a month, they are still not swimming in cash, right? So they are, and especially if they have kids that go to school, most of the time they barely meet the end of the month. How do you foster this literacy that allows them to change the mindset? Because very often, if you're talking about $1 a month or a day, of course, if you make $2 a day, you won't be able to do this, right? But if you're talking about a $300 to $500, is a 5 to 10% of salary, which seems reasonable. And maybe in that case is buying a couple of shoes less, So how do you push this culture?
There is no simple answer to this. I have to be very honest here. But there are several attempts that are made, and more can be made.
Maybe share a couple of stories in countries that you have worked. Yeah. That might be a good way of doing it.
India has given a lot of focus on financial literacy, and they're creating an ecosystem, or have already created, in terms of digital ID, banking, payment systems, and so on and so forth. India is not a representative sample currently of rest of the emerging markets, or the developing countries, as you may call it. But however, they were there 20 years ago where a lot of countries are now. So in India's case, they have taken on educating people as a public good, right? And so that private players do not have to spend money on creating awareness around why you need bank accounts. You have the best cricketers in the world. In India, cricket is religion.
Yeah.
So they have the top class cricketers coming and saying that maybe you should, invest in mutual funds. It's the right thing to do. And hence this whole buzz around that I don't want to miss out on this opportunity. So even the food delivery guy is sitting on his smartphone, scrolling all day long, and he's got MS Dhoni and Sachin Tendulkar telling him, mutual fund sahi hai, which is saying that mutual funds is the right place to save. Yeah. Or that saving does not mean putting money in a cupboard. You should actually invest your money. So the difference between investments and savings. Targeted financial literacy for women through the self-help group structure, down through the villages, up to cities. So these kind of public goods help for players like myself when they come in and approach these self-help group women, or the truck drivers, or the domestic help, because they seem to be aware somewhere. However, the other challenge lies around the friction that you have when accounts need to be opened. So financial literacy, assume that they have understood what it is. But sometimes the product design can be so complicated that even you and I sometimes find it difficult to understand the product. So that is the other simplicity that needs to be thought through. How is it that you can go through trusted players whom these people and individuals understand, and not some complicated names that you and I are used to? I'm not going to take any names here, but just simple in India, State Bank of India or LIC or something like that works. And I'll give an example of other countries also. So when you go with a product like that, there is instant trust and say, okay, fine, this is something that will work. The simplicity of the technology at the front end needs to happen. And in developing countries, not everything is totally digital. Even in India, given that we have all these digital touch points, yet there will be people in low income areas who want a receipt. They don't trust an SMS.
Yeah.
They don't have smartphones. So those are the things what we call phygital. Physical, digital, so we call it phygital. And the most important thing that is another friction area or a trusting issue is the services that they get. When you and I, Matteo, want to interact with our financial product, we have the app, we have the helpline, we're on top of the question we want to ask. Sometimes maybe the helpline individual may not have the answer.
Actually, the least interaction is the best, in this side of the world.
But in this side of the world, they are intimidated already to go and call someone that I don't know what to ask. And they are simple questions.
Yes.
What is the value of my money? How much money have I put in? What will happen if I pass away? They're only interested in that. And the most basic question that we always get on a helpline, anywhere that we run, is, will I at least get the money what I have invested? Right? So these are very simple things. And with Rwanda, different world from India, yet they have the digital infrastructure in place. They have national IDs, they have payments, they have so on and so forth. The government took it upon themselves to run this scheme, and they incentivized them on 3 fronts. So they said that somebody who's in the all of Rwanda is broken up into 4 different income categories, now 5.
Yeah.
1 being the least, 5 being the most. Ude categories is what they call them. So the government said that whoever is in 1, 2, and 3, 1 and 2, we will match your co-contribution. So if you save an X amount, we will match it to that. Whoever is in 3 and 4, we'll give you 50% of what you save in a year. And to the category 5, no co-contributions for you, we'll give you tax incentives. And everybody in the pipeline from the time that they started to the next 5 years, get a life insurance, and they get a funeral insurance, which they call the last insurance, as a benefit. So culturally it works.
Yeah.
That has created the uptake to about 3 to 4 million. So the coverage grew from 5% to 50%.
Amazing. The scale of this.
Yes. And they're a small country, right? So in terms of population, so I will only work in terms of percent. But if you look at India, the scheme that the government came up with is a fantastic scheme called Atal Pension Yojana. But, and there are 12 million people who are in the scheme today. But that's still tip of the iceberg.
This conversation, lacks time. I know that we should spend way more time to do this, but I'm going to invite you again on Breaking Banks. I'm making a promise here to our listeners. When I was working for my friend at Omedia Network, when he was still calling this way, we invested in microinsure that had this very smart idea. I want to talk about convenience and user interface. I'm getting there, right? So what they did is that they interface with the telco operator that was selling microinsurance products, and the users were allowed to pay them with a fraction of the airtime, which I thought back then it was one of the brightest idea I've ever seen. And also, you were talking about, convenience and affordability, but actually how easy is, to have a third party that is already used every day. So the customer journey, isn't that a super important part of this?
If Parul also goes and stands in front of people and say, I think you should do this, they're like, who are you? Right? So it has to be in the interface that these people have every day. It cannot be someone new, and it has to be as easy as putting money into their mobile phone. It has to be as easy as buying a vegetable or making a contribution. There's one more thing in all of this that I just want to touch upon is that pensions alone cannot work. And one of the reasons why people are not able to save into their pension accounts is because what even Queen Maxima said, that it has to be financial health, which is that I have to have short term, I have to have long term, and I need insurances. Because remember, Matteo, unlike you and I, they are meeting their risks with current income or with credit. Right? So if a cow dies, they take out money from under their pillow and they still don't have enough money. So they'll go to a local neighbor who will charge them 50% interest or more.
Yeah.
And then they will match their money and they will go and buy the cow. So what it does is not only have they consumed their current savings, but they've also mortgaged their future income.
Yeah.
And then they get into that cycle of always paying this guy, paying that guy. So, but if they had maybe a fraction of a group insurance where the premium amount is much less, then they will suddenly have all that money to then put for the child's education, marriage, house, and then think of actually realistically putting money away for the long term. And women are even more particularly vulnerable to this, Matteo. Women outlive men. They don't get the same kind of income in comparable jobs. They're in and out of workforce due to childbirth and family responsibilities. And yet, globally and everywhere in reports, everyone knows that women are better savers. And they're 50% of the workforce that lives on this country. On this world, not a country, sorry. They're 50% of the workforce who lives in this world.
Yeah.
They're 50% of the reproductive population. They are 50% of everything that we do. And yet the society has put in some norms around what is a productive activity and what is not, leaving them even more vulnerable to old age. So maybe some focus needs to be brought about in that herself. And she's the one who's going to teach her children way more and secure the future. You know, this, as they say, you want your village to progress, teach the woman what to do. She'd not only do it to her house, she'd take the village to another level.
The reason why I wanted you to come and have this conversation at the show is because this topic, it's something that unless you are in the you are in the middle of a silver economy, you don't think about it, right? And I do want to start with the part of our listeners that is clearly far from having these kind of worries, to open their eyes and think, hey, maybe there is some lights, some bulbs, in my brain that needs to be lightened up. And I thank you a lot for having shared these insights with us.
Thank you so much. Thank you. Can I just add one thing, Matthew?
By all means.
I think for the listeners, I think there are two-pronged approach that could be thought of. One is, what is it that I can do as an individual? And if there are businesses, what is it that they can do to collaborate to make this happen? And it is also for the stakeholders and the communities to think, if businesses do not find this opportunity to be lucrative or sustainable or to be profit making, they don't join this business. But it is just something that doesn't give you instant gratification. Even on a business level, it comes on maybe 5 to 6 years on. There's no horizon in 1 or 2 years. But there is a case where it has to be a public-private partnerships. They have to have local stakeholders, payment providers, telcos, all of them to come together to make this happen. Otherwise, it's not going to happen. It'll just again be talk.
Parul, thank you very much for being with us.
Thank you so much. Thank you for having me.
That is Breaking Banks Europe at the CXO Conversation, live from Singapore Fintech Festival, and it's a wrap. Welcome back to Breaking Banks Europe. We are here live at the Singapore Fintech Festival, hosted by the CXO Conversation. Thank you very much for giving us the opportunity to record in this amazing studio. I'm here with Samantha Ghiotti, co-founder and CEO of Abito. Samantha, welcome back to Breaking Banks.
Hi, Matteo. It's glad to be back.
It's going to be a super funny podcast, this one, guys, because Samantha and I usually we speak Italian, of course, And she's from Turin, and in theory, she has a sort of an accent that I love and I try to imitate. So it was impossible to even start this podcast on time with you, right? Because we were chit-chatting.
Chit-chatting in language and dialects, and Matteo being from Veneto.
No, I'm a repented Genovese. I'm not from Veneto. Come on, but I'm good. I'm good with languages, as you know. So now back to business. Sam, you are a super cool, entrepreneur, former investor, one of the young dinosaurs of this fintech of the fintech space. But most importantly, you're the only person I know as an Italian that went to Japan and founded a fintech company. Tell us a little bit the short version of how did you even get there?
Well, Matteo, you like rebels. Stop laughing at me. You like rebels. I like
this is a video thingy, right? Oh, so people will see us laughing. Is amazing. I love it.
I like explorations, right? So generally, I think about myself as an explorer. As you rightly said, I've been in fintech for a long time, right? And so as an executive, as an investor, and lately as an entrepreneur, and this kind of took me over, I'd say, 4 continents. So I've seen my fair shares of different markets, different business models. The reason as to why I'm in Japan is because I landed in Singapore about 5 years ago, just pre-COVID, to run a business called Singlife, which is a full stack digital insurance, which exited in 2021 and gave me a lot of, I'd say, on-the-ground insight around customers' preferences when it comes to wealth creation and the role of savings, in particular, the emotional role of saving, particularly when you start on that journey. And on the back of the transaction, my co-founder Liam, myself, and Andre, formerly CPO also at Singlife, we kind of sort of rebooted the team with this idea of sort of continuing some of the journey that we started at Singlife, which was somewhat interrupted by the transaction. So, sometimes what looks good from a financial perspective may not necessarily feel the same from an emotional standpoint. And I think what brought us back together was this idea of unfinished business. And so we started to look at markets that showed particular propensity towards savings. And so that's where we landed, I would say, pretty quickly on Japan. We're fascinated by Japan, right? Because Japan...
Did you know the ecosystem before? Or
I had worked in Japan before, but mostly as an investor. So I had sort of a series of connections from an LP perspective and whatnot. But I speak zero Japanese. Never lived there.
Still speak zero Japanese.
Arigato gozaimasu.
Yeah. I could almost get there.
It was curiosity in a way that took us to Japan and sort of started to literally sort of peel the layers of this incredible place. Japan feels, for an outsider looking in, very much like a black box. Okay, it's fascinating. There are lots of things that the world is, think about Japan.
A yellow box, I would almost say, but that's okay.
Some to say that too. The more we dug, the more we uncovered really interesting customer behaviors. There were 2 other factors that made Japan more attractive. One was that the regulator had introduced a new regulatory regime in 2021 called, aptly so, the new intermediary license, which is incidentally how we're regulated. And we ended up actually being the very first foreign entrants in Japan to actually get this license.
Because there are no Japanese, right, in the founding team?
No, there are no Japanese in the founding team, although very, very quickly we realized that we needed to have that Japanese angle and to be credible and, frankly, to be able to interact in the local country, right?
Yeah.
So
there are a gazillion questions, by the way, I wanted to ask about, the cultural aspect of your non-Japanese building a Japanese company. Oh my God.
We could be here for a month, right? So I know we only got 20 minutes. But so we So the regulatory side, which kind of worked in our favor and gave us the opportunity to enter the market with a far less burdensome, if you like, licenses and regulatory regime, which helped a lot. The other observation was that Japan it's a very large market from it's the fourth largest economy on the planet, right? Largest saving market on the planet, second largest insurance market on the planet, really high margins across all of the finance categories. So, the macro looked quite attractive. And we also realized that from a consumer perspective, there were only really two, I would say, typical experiences in Japan. One is like the real bricks and mortar, paper laden, very all complicated, etc. And then there's a few that are emerging in the digital space that feel and look more modern. But basically, we realize that there is an opportunity for a player like us, who is an intermediary of financial services, in particular saving, investment, and protection product, to enter a market with a fresh brand and a fresh proposition. To the question of the team, in Japan, gray hair matters. Experience matters. I keep saying, when people say, "Oh, well, tell me what you've."
Does no hair count, or
no hair doesn't count?
Oh, okay.
No hair is like, no, you won't fit.
Yeah, that's why I do Africa,
just
guys.
Just gray hair. So we very, very quickly got to hire up COO, Kume-san, who was previously the chief executive of BNP Paribas Cardiff in Japan. Very seasoned executive in the insurance space, so very well known by the regulator, and that opened the door very quickly to the license, partnership relationships. And so, the rules of the game and how you build a startup in Japan is a little different, right, than what probably we would have done elsewhere, right? You do customer product regulation. In Japan was the opposite. You do regulation product customer. The fascinating piece, and continues to remain so, is, on one side, getting under the skin of the Japanese culture when it comes to consumer preferences, buying behavior, and decision making. And on the other side, it's like building a team, right? In a country where you don't speak the language, your partners don't speak your language. You can use your hands as an Italian for a little bit. Right? After that, it's like it doesn't work anymore, right? Yeah. So we got to this point of the mental model for building a team needed to be a little different. And I have this, idea of, almost creating a human middleware, where we need to have a layer between the foreign founders and the people that interact exclusively domestically, with a middleware of human interaction. And it's not just translations, literally, of the language. It's really this cultural meaning making about, what you see is not what you really should be reading. What you get is really not what you expect. And so purely from a, I would say, exploratory perspective.
Yeah,
it's a really fascinating experience.
Yeah, I was trying to put myself in your shoes for a day, and even asking myself, okay, but do you even do the meeting in English, or there is a translator? Because if there is a translator, it's awkward, right? Or indeed, doing some of the job interviews where every single parameters is not the same of what you're used to, right?
Yeah. I'm just going to give you a small anecdote.
Please do.
Japan is the only country where I worked in where I had to build a PowerPoint presentation for the husband or wife of the candidate. So
you need to sell the job. You need to sell the job
to the partner of the person who's ultimately taking the job.
Oh, okay. It sounds like when you marry someone and you need to bring the daughter. How do you say it?
A little bit. But it's it was fascinating just interviewing.
But is that like a common practice, or they didn't trust the Westerns, setting up the company?
It's a little bit of both. The reason for mentioning this anecdote is how decisions are made in Japan. It certainly happened to me on a couple of occasions that candidates that had accepted the offer, signed a document, then came back and reneged the whole thing, said, sorry, my current employer doesn't want me to go, doesn't let me go, I can't. And I'm like, what do you mean? Like termination? Like,
Yes.
giving
Exactly.
notice? And they're
Like a free market competition?
Cannot do that. No, everything must be done in harmoniously.
Yeah.
Right.
So the feng shui of the office was the basic, was really the basic stuff, right? Okay. So and just to for our listeners to sort of understanding, Abito is a mix between a PFM and a savings organizers where you can buy insurance products, savings products. Is that?
Yeah. So technically, we're an intermediary, right? So we are distributing third-party products.
Okay.
And we acquire customers on a saving product with a.
And it's a B2C.
It's a direct to consumer.
Okay.
Yeah. So we acquire customers on a saving product, very attractive saving rate, 0.4%, which in Japan is as good as it gets.
Yeah.
With an attached debit card, and we then provide customers with free financial advice, and that is the hook that takes customers into a deeper relationship to help them build their investment portfolio and their protection portfolio.
So there is a financial literacy component as well, or because it doesn't seem Japan needs it. They seem all super I want to say wise. Financially no.
It's the opposite.
Oh, really?
Yeah, that's why Japan is fascinating. It's like in a black box. The more you dig, the more you uncover. Japan has the lowest level of financial education across all of the OECD countries. The reason is historical reason, right? Because over the last 20 years, the so-called lost decades, the interest rates have been zero, sometimes even negative, for such a long period of time that the most common finance behavior in Japan is going to work, taking 30% of your paycheck and put it at the bottom of a zero yielding bank account for 20 years. So they basically save their way to retirement, never hoping that those savings generate any yield. And then, buying, I would say, life insurance very early. And so the combination of the two, savings and life insurance, is, I would say, the financial behavior that underpins a deep, I would say, risk aversion across everything, right? And so helping customers building what we call a better money strategy, a more befitting money strategy to help to live to 100. That's crazy, right? When you speak to the younger...
It's also one of the oldest average country, right?
Yeah. There's a tennis club close to our office, and the average age of the tennis club is 72.
Oh my God.
Can you believe it?
That gives a lot of hope, right?
Yeah. I mean, Japan is a petri dish for what the rest of the Western world will look like in 30 years. It's older population. The infrastructure is designed and architected and optimized for the elderly as opposed to for the youngest. And everybody expects to live to 100. And, people are scratching their heads. It's like, how? Yeah.
But by the way, Sam, my own curiosity. So it looks like, common sense, but this all, I think I saw, what's the name for these startups or technologies or class of fintech startups that are devoted to the elderly? I have no idea. It's
the silver economy?
Yes, exactly. Thank you. Silver tech is okay. Is Japan a sort of a poster child for silver tech or not yet? Or it will be?
Good question. I don't see it just yet, but it could be because simply because the elder population. When I say elder, I mean really the 60 plus, and there's a lot of them. they're really used to a very different level of interaction. They're not that digitally savvy, you know. People still go to bank branches in Japan, right? And the financial institutions, I would say, the large banks, you know, MUFG, SMBC, Mitsuo, they're barely now beginning to think that some branches are worth closing. So it's basically Europe like 20 years ago, right?
Oh, okay, super interesting.
Yeah,
Okay,
it's fascinating.
And what about? I mean, because without I want to say without undermining Abito at all, but it doesn't seem like the idea of Abito is revolutionary, right? Technological as the so
absolutely not.
Exactly. So I knew I wasn't saying anything.
No, you're not offended.
Exactly. So. But of course, you're still a pioneer, you know, even if you brought an idea that technologically per se doesn't have a super high barrier. So what else is in what it seems like a land of opportunities? I mean, where is Japan in its fintech journey, in your opinion?
Emerging. It's the answer.
Amazing.
It's emerging. People don't necessarily, that's what I'm saying. Japan feels like a black box because people think about, you know, mangas and fast, high-speed trains and, you know, technology, robots and things like that. But when it comes to finance, they are at best 20 years behind the rest of the Western economies, at best. And, you know, there are regulatory reasons, you know, there are cultural reasons, there are market infrastructure reasons, right? There's lots of reasons, and so it's emerging in that respect. You know, an interesting data point, which often I quote with investors, is Japan is 120 million people, fourth largest economy on the planet, very well educated and notionally wealthy economy. They have the fintech density of Estonia. Just over, you know, couple of hundred fintechs. You know, there are more fintechs in Singapore, way more. We're talking about, you know, 5,000-6,000, right?
Yeah.
Let alone places like the UK, continental Europe, right? And I find this fascinating.
It might be even the single things where Italy beats Japan. I'm not sure. It might be.
I was thinking, I didn't want to sound so judgmental about my own country.
Exactly.
But it's certainly unusual. And I can tell you, you know, you said you're the only Italian that sort of on this journey. I can tell you for sure that I'm the only Italian on this particular journey. So that one, I do feel, you know, a pioneer. But I can also tell you that I'm one of the very, very few foreign entrepreneurs because the environment is so domestic that
certainly,
you really...
I don't know in how many fingers you can, of how many hands you can count the female fintech CEOs in
tech
in general.
Yeah. It's a Venn diagram with one person in it.
Amazing. That's why. Yeah, you know, I think that's why we get guys, for the ones who are listening. So Samantha and I look like we are neighbors for the past 25 years, but we only see each other once every 2 years and at the fintech event. But literally, after 2 seconds, we start laughing and, you know, sharing a gazillion of things about life, because we are both Italian, but also because, you know, probably if I write the second edition of Talent and Rebels, the first person I will think of will be Samantha.
Okay, I'm not sure it's a compliment, but I will take it as such.
No, you should. Samantha, last question, because we could totally stay here the rest of the day and having fun. One conversation where we are at the last day, and I don't want to say finally, but we are at the last day of a very intense Singapore Fintech Festival. Why don't you share one conversation, one session you listened to, beside this one, of course, which is the highlight of your week, I'm sure, and not the second best conversation you had this week after this one.
This week I had a couple of good conversations, I have to say, mostly off stage and mostly, I'd say, corridors conversations, right? Which often are the best, a little bit impromptu. I had the pleasure of reconnecting with my previous team at Singlife, which was amazing. This was over
because this is your home for 5 years, right?
Yeah, almost 5 years. That's right. So that was it was fascinating to see where everybody got to, and the journeys that everybody embarked upon after that experience. And it was a little bit like what just happened now, that we sat down, we started laughing, and so we just gathered around a couple of beers, and all of a sudden it was like, conversation, like,
as
we
you
were
never left.
never apart, which was amazing.
Yeah.
The general atmosphere here, my general sense is that there is more space and focus on the larger financial institutions than from startup perspective. I was looking at the Investors Lounge, which was frankly deserted, right? So this funding winter that has affected pretty much every single entrepreneur in, whether it's in fintech or not, it's real.
Yeah.
You feel it, you see it, and hopefully we'll see, signs of, I would say, fresh shooting, sort of, maybe early spring, hopefully in 2025. But it was quite striking for me to be here, and having been here in, other years, 2021, you can definitely feel the difference.
Interesting. Sam, they are telling us once again that we went, of course, behind behind the due time. Thanks a lot to be back at Breaking Banks.
Absolute pleasure.
And guys, thanks again for the CXO conversation to host another episode of Breaking Banks Europe, and that's a wrap.
Thanks for listening to Breaking Banks Europe, a Provoke Media podcast in cooperation with Fintech Stage. Don't forget to tweet us out, shout out, or post to the team at Breaking Banks EU on Twitter. If there's something or someone you'd like to hear on our cast, let us know. See you next week on Breaking Banks Europe.